In this video, we'll be talking about inflation. Inflation refers to increasing prices over time. You could be talking about the price rise of one particular item, an industry, or just the general price level. Typically, when we look at this in a macroeconomics context, we're talking about the general price level going up or down in an economy. It doesn't mean that there's an equal price change for all goods and services. Oftentimes, inflation looks at an average and changes in prices. Inflation reduces the purchasing power of money because it now takes more dollars or more currency to buy the same quantity as previously did. Deflation refers to decreasing prices over time. This can also happen. Generally, it does not happen as often and more likely is for specific products rather than the economy as a whole. When we talk about the inflation rate, we're looking at a percentage change. Typically, prices from one year to the next. So an inflation rate of 10% typically means that prices are higher by 10% since last year. You can have the inflation rate for a single item, the entire GDP, or we could be talking about a price index. For example, if the average house cost $483,000 in 2021 and $508,000 in 2022, what is the inflation rate for 2022? So inflation rate is just a percentage change. So anytime you see rate, usually means percentage change. Here we're talking about inflation, so we're looking at how prices changed over time. I'm going to be using the formula where we take the new value minus the original value or the old value divided by the old value. Sometimes this is called the endpoint formula. There's also other ways of calculating percentages, but this is the way we're going to do it. Or at least the way that I'm going to do it. Okay, so the new price is $508,000. Old price is $483,000. So prices went up by $25,000. We divide that by the original $483 and then multiply that by 100 to give us a rate of 5.18%. So prices went up by a little bit over 5%. Types of inflation typically categorize the general cause of inflation or which sector of the economy is driving the inflation. Demand pull inflation is inflation that's caused by demand. If you remember when we looked at our market graph, an increase in demand causes prices to go up. So demand pull inflation would be prices increasing because we have rising demand. Typically, this happens when there's excess spending relative to the level of GDP or the level of production. Sometimes this can happen when the central bank issues too much money. We have lots of money, we have lots of cash access for purchasing things. This is going to cause demand to increase and thus prices to go up. We can also have cost push inflation. This is inflation that's caused by a shift in the supply curve. Remember, shifting supply to the left is going to increase prices. Often this happens when there's some sort of rising input costs. So land, labor, capital, some sort of resource in the factors of production is becoming more expensive. Sometimes this can happen with a supply shock, which is a very sudden, sharp decrease in the supply of one or more items. In the US, typically this happens with oil. If we have a sharp decrease in oil, shifts to the left, causes prices to go up, cause inflation in the economy. Core inflation is going to look at price changes of stable goods. So we're going to take out things that are more volatile, that have frequent price changes. Core inflation is trying to look at maybe a permanent price change, something that's not going away. And it's going to ignore goods that have wild swings of price in the short run. Generally, like food and oil will be taken out of the core inflation price because food prices fluctuate a lot, especially produce. Apples might be really expensive in part of the year, really cheap another part of the year. Oil has lots of fluctuations in price throughout the year. It's very volatile. So core inflation tries to look at how stable goods are changing in prices over time. Hyperinflation happens when you have an extraordinarily rapid increase in prices. You could see the lady in the photo on the right. She actually has a pile of money that she's using to burn. She's using this for heat, for cooking. Money has become worthless because of hyperinflation. Hyperinflation devastates an economy. Businesses don't know what to charge. Consumers don't know what they should be paying for things. Money becomes worthless. Sometimes this happens because governments are printing a lot of money. Happened in Germany after World War I. One US dollar was worth 4.2 trillion German marks. In Zimbabwe in 2008, they had 14.9 billion% inflation, which meant something that was worth $1 one day is worth almost nothing the next day. Currency becomes worthless. Money becomes meaningless. There's so much money out in circulation that it doesn't mean anything anymore. You can see in this photo on the right, that is a $20 billion bill for Zimbabwe dollars. Because of hyperinflation, rather than having to carry 20 billion bills around, they just reprinted the currency. This didn't help because it wasn't fixing the underlying causes of inflation. What was causing the currency to become worthless so quickly? 3 eggs cost 100 billion Zimbabwe dollars. In the United States, the end of 2022, early 2023, egg prices also were kind of high. Not nearly that much, but you could easily find a dozen eggs at the store for $7 to $9, which is typically considered very high. Usually eggs are $3 to $4, sometimes even less. But inflation was nowhere near this. Imagine it costing $100 billion to buy 3 eggs in the United States. Hyperinflation causes currencies to become worthless. As we look at our economy as a whole, national policies through the central bank and the fiscal policies of the federal government, they don't want hyperinflation. They're trying to keep the economy going. They're trying to prevent recessions, but they also want to prevent high levels of inflation. You'll see in the United States during the COVID pandemic, the government and the central bank did a lot of things to try to stimulate the economy, increase demand, increase the amount of money in circulation. As inflation levels started to rise 2 and 3 years into the COVID pandemic, they had to switch gears and turn to contractionary policies or things to reduce levels of inflation. This graph looks at inflation levels from the 1960s all the way to 2021. Generally, we've had stable levels of inflation under 5%. In the 70s and the 80s, there was a peak in inflation above 10%, up to 13-14% in the 80s. There are potentially many causes for this and reasons why. Often in the 70s and the 80s, the high inflation levels are linked to high oil and gas prices. We could see during the financial crisis, the recession of 2007 to 2009, we didn't have inflation. It dropped. It even went a little bit below 0 for a while. Then it fluctuated between 0 and 2%. 2021, the last date on this graph, shows about 4.7% inflation. Later in 2022, it went up to 7, 8, 9, 10% inflation. And depending on what industry you're looking at, if you're talking about food prices or oil, if you're talking about housing or general inflations, depending on what area of the country, numbers could even be higher. What's inflation right now? Pause this video, do a Google search for US inflation rate. Price indexes are one way that we measure inflation rates or inflation levels. A price index represents an average change in prices of some sort of basket of goods. In this case, it's not a literal basket of goods, rather it's a representation of things that people generally consume on a regular basis. Price indexes are always going to have a base period, some sort of time period that's used as the starting point to compare price changes against. You can have a base year of last year, 10 years ago, 100 years ago. It doesn't really matter when the base year is. It's just going to be something that we're converting all years into that same price. The Consumer Price Index, or CPI, is one that you may actually start hearing about a lot in the news. Maybe you have heard about it before. Now that you know what it is, it'll probably pop up and you'll notice it from time to time. The CPI, or Consumer Price Index, is trying to measure some sort of basket of goods that a typical family of 4 would consume in 1 year. The CPI is measured by the Bureau of Labor Statistics. They take those same items every year and they look at how prices are changing over time. So the CPI is going to have a fixed quantity of all of the items in the basket, and the only thing that's changing is the price. And when we see the value of this at the end, it will give us this difference in price that's supposed to be representing the inflation for households. So to calculate the CPI, this is similar to how we calculate any price index. We take the price or the value of the market basket in the current year and divide it by the price or the value of the market basket in the base year prices. And then we multiply by 100. There's also the Personal Consumption Expenditures Index, or PCE. This is also an adjustable basket, and it accounts for changes in consumer behavior. So if we switch to a cheaper substitute, this is measured by the Bureau of Economic Analysis. This is another way of representing inflation for households, but instead of having a fixed basket of goods, it's an adjustable basket. So the things in this basket change, but it's trying to represent general costs for a household. There's also a Producer Price Index, or PPI. This is going to measure changes in prices received by producers. There can be a PPI for a specific industry. We could be talking about the PPI for all producers. Any of these indexes, we will be calculating the same way. So the value of the basket in current year prices divided by the value of the basket in base year prices, and then multiplied by 100. In the nominal versus real GDP video, we also looked at calculating values of a basket of goods. We looked at how indexes, in the base year, we're going to have a price index of 100. If you have a price index of 200, that means prices have doubled since the base year. Or 300, prices have tripled. A price index of 110 means that prices have gone up by 10%. We also looked at this in our nominal versus real GDP video. We have a basket of goods in 2007 and a basket of goods in 2008. So if 2007 is the base year, what is our price index for 2008? So using 2008 prices, we calculate a value of this basket at $50.88. So we have 4 things in this basket: DVD rentals, movie admission, popcorn, and soft drinks. And a certain quantity is selected based on what is considered typical consumption. So the basket in 2007 is the quantity of DVDs times the price of DVDs, plus the quantity of movies times the price of movies, plus the quantity of popcorn times the price of popcorn, plus the quantity of the soft drinks times the price of soft drinks. So we get $50.88 in 2008. The value of the same quantity, the same goods in 2007 is actually $48. That's going to be our base year, and so we're going to divide current year by the base year and then multiply by 100. This is going to give us a price index of 106. Prices have gone up. So anytime you get a value over 100, that means prices have gone up. Now, if you notice here in the prices, DVD price went from $225 to $297. Movie admission also increased from $7.75 to $8. Price of popcorn stayed the same, and the price of soft drinks decreased. So we don't have equal price changes. Some stuff is going up, some is down, some is the same, but we have an overall increase in the price. What is our inflation rate for 2008? So the price index is 106. What is our percentage or our inflation rate? To get the inflation rate, we want to calculate the change in price. So $50.88 minus $48. So the change in price. So new minus old divided by old times 100. This is going to give us an inflation rate of 6%. So 106 represents an inflation rate of 6% over the base year. If instead we were looking at the difference between 2 years, so maybe we have a CPI of 250 in a particular year, say 2022, and the CPI in 2023 is 275. We can also calculate the inflation rate from those numbers as well. You would say the new value, 275, minus the old value of 250, divided by 250, and then times 100. This is going to give us an inflation rate of 10%. So whenever you're calculating a percentage change, you take the difference, divide by the original value. Anticipated inflation means that we expected it, we planned for it. It's a price change that people expect to happen. Anticipated inflation generally is some low, consistent amount, 1, 2, 3%. Unanticipated inflation wasn't expected and causes changes in real income and wealth. So why does unexpected inflation hurt your wealth or your income, but anticipated inflation doesn't? Well, one reason is that if you can plan for price changes, it can be built into employment contracts. If you know prices are going to go up 5% every year, when you get a job in your contract, it'll say you get a 5% raise. Your real wages aren't going to be changing. But when all of a sudden inflation is 10% or 15%, it's higher than what you expected, now your purchasing power has gone down. Real interest rates are going to be the nominal interest rate that's been adjusted for inflation. Just like with real and nominal GDP, we're going to be trying to take out inflation. So the nominal interest rate is just the stated rate, nothing that's been adjusted. So if you go buy a car and they say, we're going to give you an interest rate of 6.75%, this is the nominal interest rate. And your nominal interest rate includes a real interest rate that the bank wants to earn, plus whatever they expect inflation to be. So if the bank is charging you 6.75%, it's because they expect some level of inflation. They want to earn a certain amount on their money, but they know that over time when you're paying it back, the value of what you're paying them back is going down. And so they want to make sure that the dollars you're paying them back in the future are not worth less than what they lent you in the first place. We can rearrange this equation. If we're trying to calculate the real rate, we could take whatever the nominal rate or the stated rate on a loan is, and then subtract the inflation rate, the actual inflation rate. For example, if we have a nominal rate of 6.75% and we have inflation of 4%, what is the real interest rate? Say 6.75 minus 4 equals 2.75%. So after we take into account the fact that prices are going up and the money is worth less when it's being paid back in the future, then the bank or whoever is still earning 2.75% real interest. As we learned back in chapter 3, buyer and seller expectations can affect behavior today. And so deflation can actually be really dangerous, especially if it's long-lasting and becomes anticipated. If buyers expect prices to be lower in the future, they're going to reduce their demand today, which can further reduce economic activity. So who is helped and who is hurt by inflation? If we have anticipated inflation, it can be planned and controlled for, but unanticipated inflation can help some people and hurt others. When we're looking at borrowers versus lenders, inflation is going to affect the real rate. So real is equal to nominal minus inflation. When the bank sets the interest rate, they're setting the nominal rate. So if they set a rate at 7%, they're expecting some level of inflation. Let's say your bank is expecting inflation to be 3%. They want to earn a real rate of 4%. Supposedly you're expecting inflation to be 3% as well, and so you're agreeing to a 4% real rate. This is anticipated inflation, this 3%. Unanticipated inflation means the actual inflation rate was higher or lower than 3%. So let's look at a case where actual inflation was 2%. Who is helped by this and who is harmed? So you still have that same 7% nominal rate, but when inflation is lower than expected, now your real rate goes up. You have a higher real rate. This is going to be great if you're the bank or you're the lender, because now you're earning more money. This is not so good for the borrower. You're actually paying back with more expensive dollars. If instead actual inflation was higher than anticipated, let's say 4%, now the real rate is dropping. Real rate goes down to 3%. So now the borrower is happy. You're paying less than you expected, and the lender is sad. They're earning a lower amount than anticipated. So unexpected or unanticipated inflation is going to help some people, hurt others, because the actual inflation rate is going to be higher or lower than what we predicted. It's also going to be a problem for people who are on a fixed income. So not everyone gets a raise with inflation. If it's anticipated inflation, sometimes those things are built in. Especially if we're talking about long term, maybe you planned for your retirement, and if you know inflation is always 2% every year, you can plan for this. You can build this into your fixed income plan for the future. If you're saving money, unanticipated inflation is problematic because it reduces your purchasing power. A COLA represents cost of living adjustment. This is something that's often built into employment contracts to make sure that your real wage stays the same over time. It's supposed to somehow be tied to the inflation rate, not just the anticipated inflation rate, but the actual inflation rate. Sometimes, depending on where you work, this has to be negotiated on a yearly basis or a regular basis. Sometimes it's already pre-built in based on the law. But a COLA or cost of living adjustment is not meant to increase your real wage. It's meant to keep your wages consistent so you can purchase the same amount of stuff that you did last year. 2007 to 2009, there was a financial crisis. Investors were buying a lot of mortgage-backed securities. These were financial investments where lots of mortgages, lots of loans given to homeowners were packaged together in one big bundle, and people could buy tiny shares of that. This was once thought of as a safe investment, but the increase of subprime lending for risky loans and the really high house prices made mortgage-backed securities a much riskier investment than people were expecting. They still kept a high credit rating though, despite the risk, and so people kept putting more and more money. Some of the lax lending requirements and low interest rates led to this housing bubble. People were borrowing more and more money, pushing housing prices up. People actually thought that housing prices would always continue to increase. Some of the loans were interest-only loans, where you just pay interest for the first few years, hoping that in the future your income would go up, or that housing prices would go enough that you could sell your house, make a profit, and you wouldn't have to pay that high mortgage value. But then the housing bubble burst because those high prices were not real high prices. They were driven by demand and speculation and expectations about the future. So demand for purchasing dropped significantly. Demand shifted to the left, causing home prices to drop. People started defaulting on their mortgages, meaning they weren't making their payments. And this happened at a much higher rate. There were a lot more foreclosures than had traditionally happened. This made these investments much more risky. People were losing money on things that they thought were a safe investment. If you want to know more about this, you can watch the video from Crash Course Economics about the financial crisis. So does inflation affect output? Cost-push inflation usually results in real decreases in output. We have our supply curve shifting to the left at a higher equilibrium price and a lower equilibrium quantity. Demand pull inflation may or may not change output. We're going to see this in our later chapters when we talk about aggregate supply and demand, but depending on if our aggregate supply curve is horizontal or more vertical, demand increasing may not be able to affect output very much. If we're working at our full capacity as an economy, increasing demand is just going to cause prices to go up. If we have small levels of anticipated inflation, this probably is not going to have much of an effect on output over time. And it costs a lot of time and effort to deal with even small inflation rates. There's costs of reprinting catalogs. If you go to the grocery store, they have price tags on every item. Those have to be reprinted or changed or adjusted by employees. If you're a restaurant, you have actual menu costs where you may have to reprint menus or reprint signs. So it's expensive. And customers don't like when prices are changing. We like certainty. And so just from the psychology perspective of keeping your customers, we don't want to have lots of price changes. There's also information costs for trying to distinguish between real and nominal prices. When I go to the store and I see that there's 18 eggs for $9.29, I need to try to figure out, is this the real price or is this some sort of inflation involved? Do I need to ask for double my salary just so I can afford eggs? Or is this a price that's temporary and is going to go down? People adjust behavior to be least affected by inflation. When inflation is high, we don't want to hold on to too much cash. Maybe we're going to put our money into bonds or other markets so we can earn interest. I may adjust my purchasing. I'm not going to buy as many eggs. Maybe I need to bake muffins. I'm going to substitute applesauce for eggs. There's lots of alternatives. Inflation may or may not affect output. It just depends on what's going on with the economy and what we expect to happen in the future. This will be the end of our video on inflation.